Okay, thank you. Um, Hello, everyone, and just want to thank you for attending today. This session is going to be a little bit of a hodgepodge of some tax issues for people with estates or creating businesses, and we'll kind of step through those piece by piece. I want to just try to introduce you to some aspects of the law and the taxation that's out there, and then from ideas that sometimes you want to try to avoid these situations. Um, just to start off here, my contact information is in the very beginning. We've got a Farmville office and an office also in Dillon. Contact information is there. The Farmville office is right down the street across from the Walmart, and then the Dillon office, we're over on Highway 15 South, just south of the Sprouse's Corner intersection. So we've tried to be convenient to serve clients in this Central Virginia area. Hill and Davis, we've been in business 25 years here, and I just want to give you an overview of some of what we do, and just see if it may be some of this that be helpful to you. Consider us a full service accounting firm. We've primarily specialize in individuals and small businesses and trying to help them save taxes, avoid taxes. So in that process, we're doing tax preparation for LLCs and the different tax forms that an LLC might be utilizing. We do corporate tax returns, partnerships, individuals, and the income tax returns that might be needed for an estate or a trust. So pretty much trying to take care of any of those tax situations is what we focus on. The fun part of what we do maybe is helping new businesses with startup and some of their getting going with computer software to take care of their record keeping. That's, for me, that's kind of the exciting thing to help a lot of folks that are starting with a new idea or an activity that they're hoping they can make a living at. And it's fun to help people with that process. We do some of the old traditional work too, monthly bookkeeping and payroll services, where we're helping calculate paychecks and keep up with that for the folks that don't want to be distracted with it. And the big part of my job, I think, is tax minimization and avoidance, where I'm trying to use my experience to reduce a tax bill, or in some cases with some choices, say from one year to the next, people can completely avoid taxation on certain types of income. So that has proved helpful. I'm also a certified financial planner, and with that, I get to help folks with college planning or retirement planning, trying to find some ways to save for those needs later in life, and also trying to create some tax deductions. We can still do that with the 529 plans in the Virginia approved arena, and make some Virginia tax deductions out of saving for college, or even money for primary private school education. There, I can run through those accounts. So my personal background, I'm a Virginia Tech graduate. I had a Bachelor in Science from there, accounting and major. I had about 10 years out in the corporate world. And after that, moved back to the Farmville area, and I've been practicing there for the last 30 years as a CPA in Virginia. We just happened to have had a family farm that my in-laws had owned and operated, that we purchased, where we operated a poultry house and beef cattle. So I've got farming experience there, and what to look for in deductions. And I managed to get 4 adult children out into the world, and got 4 grandkids. And I used to like to say, I always felt with 4 kids, I probably was going to have one of them locked up in jail, but that did not happen. So I'm happy at this point in life. So under the estate taxation issues, the items that we're going to go over is an estate tax return, and the potential income tax return that may have to be filed by estates, and also some of the issues with the probate accounting. So this is the idea of what can occur when people are passing on their assets and their wealth through a will that is being probated and having to go through that reporting process. Also, I'm going to touch on some ideas about the taxation and property transfers. A lot of people ask me about gifting or selling and inheritance, and want to try to cover some differentiation on those issues, and also just talk in general about LLC taxation, because lots of times that can enter into a potential solution for organizing business assets and transferring those to family members or other potential owners in the business down the road. So, to start off with, the first topic there is the U.S. estate tax return. And what I'm talking about there is the inheritance tax or the death tax that people die. The good news is you've got to be worth over $11 million before you would have to write a check for inheritance tax. But there's some benefits to all the rest of us that don't have $11 million that is very beneficial. And the whole idea there is they try to look at all the assets of a deceased person that they had control over. And that process, they're looking at the real estate that may have been owned, whether it was wholly owned or jointly owned, what you've got in the way of investments, stocks and bonds, money in the bank. If somebody owed you money, if somebody was paying you on a seller finance loan or something like that. And they're looking, and the craziest thing is the value of a life insurance policy that is paid to others. If you had control of that life insurance policy, the death benefit is added into that. So all of that is attempting to get somebody up to that $11 million trigger point. And again, fortunately, there's very few households in the country that bill applies to now. But everything is measured at the fair market value on date of death. And that concept is an important one for transfers and valuations later on. The good news here in Virginia is the state of Virginia does not have its own estate tax or death tax. And they dropped that back in 2007 when the federal government lapsed for 1 year. And Virginia said, we're just going to live without it going forward. And when the U.S. reinstated theirs. But, so the idea is for the estates, the property, I think of the person owns property when they're alive. When they die, their property moves into their estate. And then from there, it moves out of the estate and into the ownership of the heirs. And when it does so, for tax purposes, that's considered, it comes out of the estate at fair market value. And that's fair market value at the date of death. And that becomes the heirs' new costs going forward. So the fair market value now is the date of death. That is the cost if it was a business asset, for example. If it's a rental property, the fair market value is now as if you bought it on date of death, and that is the amount that can be now depreciated going forward by the heir when they've received that property. So sometimes inheriting business property is a real good way of for the appreciation that may have occurred on a property to never be taxed, pass to the next generation, and then they get to deduct fair market value as if they paid for the cost of that property going forward. This is the actual inheritance tax rates, and this is the taxable income once it breaches the $11 million mark. So very quickly, that percentage rate goes up to 40%, and that's why inheritance tax has been such a expensive thing that people have tried to avoid. Is back when we had a $600,000 trigger, it could be very expensive very fast, and people lots of times didn't have the liquidity to pay that. But that's just that it's an expensive tax once it does triggers for multimillionaires. When the estate assets, and I'm thinking primarily of say money in the bank or stocks and investments, when they are held by the estate waiting to be distributed, they can generate income, and they can have interest income, they can have dividend income, just like the kinds of income that you and I have to put on our personal tax returns. It also could be the estate could have to sell property and have gains or losses from the sales. And as well, lots of times people will leave their pensions or annuities and retirement to their estate. And the estate is charged with paying the income tax on that money. So the estate can have to file income taxes just like an individual does. And the thing to remember here is when there is a pension or annuity, retirement accounts that are left to the estate as opposed to individuals as a direct beneficiary on the accounts, then the estate doesn't have a deferral option, and the estate could have to pay taxes on the entire lump sum of that account immediately. Where, for example, individual IRA beneficiaries now have at least 10 years to take out that IRA money and be taxed on it. Where if the estate's going to be taxed on it, it's going to be taxed immediately the year in 1 year. This is the income tax bracket table. I just want to give you that because in the lower left-hand corner, the lower right-hand corner is where the estates and trust tax brackets are showing up. And those very quickly accelerate from a 10% bracket up to a 37% bracket on as little as $12,000 or $13,000 worth of income. So if an estate or trust has income that's not distributed, it has to pay tax at a very high rate. The one thing that we have with an option with that is trying to get it out to the individuals, where if you look at an individual's got to have over, say, $500,000 before they are of income, before they're in the 37% bracket. But an estate, as little as the $12,000, $13,000, they're in that same 37% bracket. So that you have an option with the income there to be distributed out to heirs or beneficiaries and let them pay income tax at a cheaper bracket. And that's what I'm talking about here. The estate taxation, it's a Form 1041, a little different than what you and I file on Form 1040s. But the estate can pay the income tax on the taxable income, or that can be paid out to the beneficiaries, and but it's got to be distributed to them, and they can pay the income taxes instead, the cheaper rates. The final thing that can happen if an estate has had property, stocks, or real estate sales, anything like that, they've had accumulated losses on during the administration of the estate, those losses can also be passed out to the heirs on a final K-1 from the tax return. So even if the estate was forced to sell property or stocks and lost money, the deductions aren't completely lost. They can pass out to the heirs as for the use on their personal tax returns. The other issue that probated estates have, where monies are controlled by a will, and is the reporting process. And in that process, the executor on an estate has to be acknowledged by the courts here in Virginia, and they will have to provide a report to the Commissioner of Accounts on that estate. And that is in a different position than the Commissioner of Revenue. Each county in Virginia has a Commissioner of Accounts that oversees the estate probate reporting process. And usually the process with that is they file a beginning inventory to start off with, and saying, here's the assets that we've got day one when the deceased died. And then each year after that, they give a total reporting of the money that came into the property, into the estate that may have been paid out, the final bills, and until at such time as every asset and every bank account has been emptied and passed out according to the will. So their job is to, Commissioner of Accounts is to oversee that process of an executor doing what the will told them to do, is my interpretation on it. This is one of the forms they have. It's got a few pieces on there where you've got to break it down. Sometimes the reporting on that is a little complicated, and that's something that we've helped folks get through when they found themselves in that position. So just to summarize on the estate side here, the main points I want people to try to get a lock on is that inherited property enjoys a step up to fair market value as their costs going forward in the future for sales or depreciation deductions. And also that when estates and trusts have income, there's an option there for the beneficiaries to pay taxes at a lower rate. And then in Virginia, probated assets on estates that are exceeding $50,000, there is a process that has to be reported to the Commissioner of Accounts. Okay, the next area, I just want to touch on some general ways that, 3 ways that you can transfer property, the way I look at it from a tax standpoint. You can sell assets, you can gift those, or they can be passed by inheritance. And I want to see if I can give you a feeling for what some of those choices can mean from a tax standpoint with people that may be dealing with different types of property going forward. So generally, when you sell, the seller has got the price they're going to get for selling the item, and they get to deduct their remaining basis from that. And what that is just if there's any, whatever the item they're selling, what it costs them, minus any accumulated depreciation. So if somebody had a business vehicle that they owned and they want to sell it, then we do an adjustment for the deductions that they may have taken. So yeah, it can be a gain or a loss, can go either way. The thing is, if you try to manipulate some of this with creating losses between related parties, those are not deductible. The odd thing about that is, and I had this situation occur with my mother-in-law. We bought the farm that we live on from her. She had a loss on selling the property to us because she gave it to us at a very reasonable price, I think. But that loss was not a deduction for her. That thing carries forward to me, and when I ultimately sell the property, then I can use that, her deduction in my sale loss is a deduction when I actually sell the property. So you can't manipulate much between related parties. IRS has had people do that before, and they've kind of fixed the law. Also, existing loan payoffs are not part of a gain or loss calculation. The debt forgiveness, sometimes at death, if there's a tax, the estate can have to pay tax on that item. And then, of course, you have capital gain when sale price exceeds the original cost. And I'm going to expand on that a little bit here. Just trying to give some folks a feel for, they hear about capital gains taxes, and generally the capital gains taxes on a sale of property are cheaper than the ordinary income taxes. And what can also happen is where you've got accumulated depreciation deductions that we may have had, say, on a rental property or a farm building, then that is taxed in a separate manner. In this example, I've just got a property that cost $300,000. We took $50,000 in depreciation deductions, and now you got $250,000 left that you've never had deductions for, and that's what you can deduct against a $400,000 sale price. So in that example, you've got a $150,000 gain, but that gain is broken down into 2 pieces. Capital gain is $100,000 there, and then the depreciation recapture is $50,000. And the tax brackets on those, the capital gain maximum is 20%, And some of that can be zero. You can depend on the income level and the tax return. Some of that can be zero. And then the depreciation recapture again can be capped at 25%, but depending on other deductions within the return could actually be less. So a little more expensive when you're recapturing that depreciation deduction. From a buyer standpoint with property transactions, I just try to bring this up because sometimes people don't think about it, especially if they bought a farm property that they may be going to try to operate. Usually what we're trying to do is allocate the money there between land, timber, any equipment, housing, farm buildings, fencing, wells, that kind of thing. And part of the reason is some of those are deductible and some are not. So on a land purchase, for example, the land cost is no deduction for that while you own it. Timber, there can be some deductions. If some of that timber might be sold off in the future. If the equipment that came with the purchase, then you can take depreciation deductions in a business on that. Personal residence, we get no deduction on that. But if there's housing for tenants, the depreciation deduction. Same thing with farm buildings or existing fencing, so in the wells that they're used in farm, those can all create farm business deductions for folks. So trying to allocate that is important. The second method that I want to touch on is a gift transfer, where you basically are gifting assets to someone else. And when that occurs, the cost it can be allocated to the different types, but on gift tax returns, some of these people are confused with is they hear there's a limit on how much you can give somebody, and they hear 15,000 per year. That is simply amounts over that or an excess gift that's supposed to be reported. We can give away $1 million worth of gifts during our lifetime of these excess gifts, and you never have to pay a penny in tax. And the reason is the gift tax and inheritance taxes are intermingled so that millionaires can't give away their estates and pay no inheritance tax. So they lock the gift tax and the inheritance tax together. And if gift tax were to ever be paid by anybody, it's paid by the giver, and only when they've exceeded $11 million gift. So gifting, nobody's got to write a check for it unless you've given away multi-millions. And here's just it's a little odd in that when you have an excess gift, and let's say it's a $100,000 piece of property that you've given to somebody, then the exclusion on that is like 15,000. We end up with 85,000 as a taxable gift. You go to the gift tax return, you calculate about it, $20,000 tax there, but then you find you've got this lifetime credit that knocks the tax out, and there's no gift tax due with the thing. So that it's an information return and not really getting anything done there. So with inheritance transfers, fair market value, date of death is a cost basis, and fair market value is allocated to assets, and when the heirs receive it. And sometimes with estates, it is a good way to inheritance of way it can permanently escape taxation on appreciation. But sometimes family members, takes too long for them to become part owners in properties and farms. So it's really and you also got the cost of doing estate filings when things are going through probate and not been set up in a trust to avoid that probate process. Again, the estate tax exemption, we don't have to $11 million now. This is a numerical example I wanted to give just to show the difference between, and let's say here's a parent trying to sell a farm property to a child versus gifting it to the child, or the child waiting to inherit the property, and what kind of cost basis they're going to have in that going forward. In this example, I'm saying if the property is worth $800,000, if it is inherited at death, then here's the allocation of the $800,000 to the land, timber, and things that may be deductible going forward. If they take that same property and sell it at half price at $400,000, then here's the allocation that would occur on that land and timber and equipment, and the depreciable items like buildings and fencing and equipment is reduced, so they don't get much in the way of deductions going forward. If that same property were gifted to someone, and the giver's cost, let's say that they only had $200,000 left in the investment from their original cost, then that is the number that is the recipient's cost going forward, because it was now given to them. They don't get any increase in that because it didn't cost them anything and it's not inherited. So it's just the giver's cost that they deal with going forward. So gift versus inheritance: inherited property passes at fair market value. Gifted property passes at the giver's cost. When the property passes through inheritance, you can escape some taxation on future sales of that. Okay, and this is just an example of where the same property that was, if it was gifted and sold, it'd be a tax of $80,000. If it was inherited and sold, no tax. So that's all that is. All right, the last thing I want to try to do is kind of run through LLC taxation and how that can be helpful within businesses and the choices they made, and then tell you what we do to try to control some of the self-employment tax for businesses and individuals where their farm or business activity is profitable. LLCs, you can have single owner LLCs, you can have partnerships with multiple owners, or you can have corporate returns filed for an LLC where there's a single or multiple owner. And the way it works out is individual LLCs where there's only a single owner, single member, they file the same forms as if folks that don't have LLCs file for their business or their farm or their rental. You just use the Schedule C or F or E in the personal return. And IRS kind of doesn't care. They call this a disregarded entity for tax purposes. They just treat it like it doesn't exist. And sometimes people are setting up LLCs, but they're not really owning property, got no business activity, so they can be dormant in existence and not have to file anything. Partnership returns, LLCs with multiple owners, they default to a partnership return, and that creates a flow-through process where any profit or loss from the partners go to the individual owners on their personal returns. And then husband and wives have some option to avoid that, but it's just more cumbersome to do separate split business schedules. LLCs can also choose to file C corporation or S corporation returns. So LLCs are just really versatile in tax filing standpoint. The C corporation types, they pay their own income taxes on their profits. There's a double taxation that can occur with C corporations, and we don't use those much anymore. But the profit of the corporation is taxed by the federal government at the corporate level. And if that profit later is then distributed out to an owner as a wage or dividend income, that profit is also then taxed again on their personal tax return. So that's usually why we don't use C corporations much from a tax standpoint. Basically, if you're going to try to avoid that, you've got to pay out every penny of profit on a C corporation as a wage, and then you're going to pay Social Security taxes on all that anyway. And C corporations can still deduct health insurance straight up on all their employees. S corporation is a little bit different, that the business income and expenses on the corporate tax return, but the resulting income or profit still flows through to the LLC's owner's personal return. So the thing that we are usually focusing on with that is the S corporation, that net income is not subject to a Social Security or self-employment tax. And that's a tax where individuals feed their Social Security retirement if they work for themselves, just the way that people who are employees are feeding their Social Security from their withholding their paycheck. So controlling that tax is part of what we will do sometimes with an LLC that files S corp returns, and that self-employment tax is pretty steep at 15% of the profit is the tax. Where if you're self-employed, you pay the employee share at 7.5% basically, and you pay the employer's share at an additional 7.5%. So now you're paying 15% to feed your Social Security retirement. Here's a quick example of how we try to control that. If it's somebody that was a proprietorship business and the S corp in a proprietorship 30,000, that household income is 70, the tax about 6,500, self-employment tax at 4,500, the total tax for that household is 11,000. Kind of an exaggerated example to drive home the difference there. If there's 40,000 in wages, now all of that business is coming through an S corp for the profit flow through. Same income at the household, 70,000, but in that case, the self-employment tax is out of the picture, and now there's a $4,500 tax savings. That's a little extreme, but what we try to do is come back and temper that. IRS doesn't particularly like you not to have wages, but here's more likely what will happen. That 30,000 would be split to a $12,000 wage, 18,000 is S corp income, still the same income, still the same income tax. But in this case, the self-employment tax is gone, but there's a little bit of Social Security tax paid on payroll taxes from the wages you pay yourself now from your S corporation. So still getting some savings from that, $2,700 in that example. Plus, if that savings is then put into an IRA account, you can save federal and state income taxes. One of the last things, I just put this slide in here just because I like people to try to figure out what tax bracket they are in, because any business decision that you make, you have the ability to save the federal rate plus the state rate. So 22% for federal, for example, plus 6% Virginia, 28% savings on something that you can use and try to make a business deduction happen out of that. Kind of pretty significant, can adds up pretty quickly. So with that, I'm at the end of information I was going to pass on. I was going to say thanks to the Cooperative Extension for doing this and all you folks for attending. If there's any questions, I welcome phone calls. We're going to have a chat after the end of this session, but also we're glad to sit down, and there's no personal cost for a consultation, especially for anyone, but just to help identify yourself as a seminar attendee, and that will take care of it too. Just like to know that.
Green?
Yep.
All right. Well, welcome everyone from Attorney Jim Seidel. A little bit about the background of my presentation today. Originally, this was going to be a tax and insurance day, and David Wise was going to do the insurance part. David had a doctor's appointment that he had to make today, and so I was asked to fill in. And I'm going to talk about a subject that we believe is a fairly popular subject. I know in my practice it is, and maybe other people's as well. And it's basically, how do you go about gifting your business that you might have or you might plan to have, either during your life, during disability, or upon death. We have found that a fairly common question. Tom Hill has just covered some of this. We're going to take it from more of an attorney's point of view, a lawyer's point of view, and maybe expand on it. And I'll try to skip over any slides that he already covered. So again, I want to thank Jennifer and Amber for having me speak, and for the Virginia Cooperative Extension. This, by the way, is the third week in a row we've done one of these webinars, and I think we're putting out just incredibly good information. And if you hang tight, you're going to get good information as well today about this important issue of how do we gift a business down to your children, down to your spouse, down to a partner, down to a third party, or whatever. Okay. So a little bit about me, second generational lawyer. My dad started the practice in 1941. I've been a lawyer since 1980, former judge advocate with the Armed Forces. My concentration is estate and business planning. And I always like to say very few lawyers really specialize in these two areas. And that's what I do. Juris Doctorate degree, Masters of Law and Taxation from William & Mary, license in Virginia, Maryland, DC, the U.S. Tax Court, and for the United States Supreme Court, and a member of the National Network of Estate Planning Attorneys. I have a roving practice. My main office for most purposes, for most people attending this, will probably be my Dillwyn office. I also have an office up here in Barboursville and some other places as well. You're going to note the biography. You're going to note references to introductory booklet. You don't have that. I think you've got to talk to Amber maybe after the presentation to get the handouts. I think I've got a slide on that as to what you can get from this office following this presentation, including a copy of the slides. And I think you can even get a recording of this presentation. This is my associate, soon to be licensed attorney, Sonia Ristici. I bring her up because sometimes she assists me in getting cases done. So she may be involved. If you do come to us for assistance, she might be the person helping you out. Okay, so gifting and estate and business planning. When we think about a gift, we think of two parties. You got a donor, the person giving the property away, and the donee. So I'll be using those words throughout here. Donor is, again, the person making the gift. The donee is the person receiving the gift. And of course, no donee is forced to take a gift. Donee can always refuse it, sometimes technically called a disclaimer, in which case the gift either goes back to the donor or goes to the contingent beneficiary. So there are types of gifts. There are gifts of personal property. By personal property, I mean non-business property, and gifts of business interest. And our focus on this presentation is gifts of business interest. So you've got a limited liability or a corporation, or for that matter, an unincorporated business, and you want to somehow gift that to children, spouse, third parties, and that's what we're focusing on here today. Kinds of gifts: you can give real estate gifts, you can give tangible personal property, such as trucks and vehicles and wagons and tractors and tools. Gifts of intangible personal property like bank accounts, investment accounts. Gifts of capital assets that are either appreciating or depreciating. And it's important to know what a capital asset is, because it can have a significant difference in how we handle this gift for tax purposes. So methods of gifting: you can do lifetime gifts, which is really kind of the focus here. Testamentary gifts, which are gifts made at the time you pass. The gifts can be revocable. They can be irrevocable. Gifts can be outright. You can give gifts in a trust. Gifts can be conditioned or unconditional. I've got a case right now going where someone is giving a gift on the condition that they continue to be employed by the business. Parents might do that, where they say, look, kids, we're going to gift this to you, but only on the condition that we continue to be employed and get an income from the gift. Or there can be unconditional gifts. Gifts can be subject to debt, or gifts can be given without any debt, which means that if the gift does have a debt, it's typically paid off from what's called the residue of the estate before the gift is made. And gifts can be to charities or non-charities. So you can see this is actually probably a 2-semester law school class that I'm going to try to wrap in for about 20 minutes, my 20 minutes today. Reasons for gifting: love and affection. I hereby give my business to my son or my daughter out of my love and affection for the kid, especially if he's helping out and is an important part of the business. To reward or compensate the donee. So you've got a business going, one of your kids is helping you out, the other 2 or 3 kids are off and running someplace else. You might want to reward the kid that stayed behind and helping out in the business by gifting him business interests. It also avoids the donors' creditors, such as nursing homes or assisted living. This is a big player that we are involved now. We've got people who have businesses, sometimes quite wealthy businesses, and we're maybe heading for a nursing home. Maybe we have some concerns about debt problems, and we want to, without getting involved in what's called fraudulent transfers, we want to gift this away to avoid those potential creditors or debtors. Or to avoid estate taxes would be another reason for gifting. So there are a bunch of reasons, but here you got 4: out of love and affection, to reward or compensate the donee, the person receiving the property, to award the donor's creditors, or to, avoid the donor's creditors, and to avoid real estate taxes. So here again, reasons for gifting business interest. Kind of a rundown. There's some additional reasons here. You might want to be retiring from the business. And when you gift, you can gift anywhere from 1% to 100%. One of the nice things about gifting in a business, as opposed to, say, gifting real estate separately, is that in a business, you can give percentages, and you can gift that just by way of an annual meeting. We hereby conduct the meeting. We hereby gift 10% to our child. Everybody signs off, and voila, you've got a gift. So it's a really easy, convenient way to gift assets by way of a business. Now, there are problems with gifting of business interest. As soon as you gift anything to a child, for example, let's say you give 1% of your business to your child. Well, that 1% entitles that child to all of the rights of the general rights of all members. The right to attend meetings, the right to be notified of the meetings, the right to vote, the right to disagree. In some cases, the donee is going to be required to sign off on transfer of business assets. So that gets to be a problem where later on the donor, let's say the parent, says, oh my gosh, I didn't know what I was getting into. I wish I could take the gifts back. And usually, unless the child agrees or the donee agrees, you probably can't take back a gift that was completed. Like I said, usually cannot be reversed without the consent of the donee. I've actually had, last year, I had 2 cases where we had given a substantial amount of money to the kids, and then realizing that for a variety of reasons, one of which is to avoid some of the problems Tom brought up with increasing capital gains, we gifted them back. As a matter of fact, just a week ago, I had one, it was a Maryland client who passed away after we had gifted everything back to him. And now when this goes back to the kids, they're going to get what's called a step up in basis for capital gains purposes, and they're going to be much better off than we were earlier. Again, no step up in basis. Now, when you make a gift, I'm going to try to bring this home today. When you make a gift during lifetime, and Tom Hill made the same point, you get what's called a carryover basis, which is can be a very low basis, so that when the person you're giving the property to subsequently sells the property, they can pay significantly more capital gains than if you had given it to them at the time of your death. So, and this can trigger the 15 to 20% capital gains tax. Here, I've just got a couple of charts here for gifting. This is a limited liability gifting to others. So you have a limited liability company. You want to gift a certain percentage to a spouse, a child, some other person. You can do that. It's at your option if you want to do that. I've got a case now where we've got 2 unrelated parties, where one party, for a variety of reasons, is transferring the entire limited liability company to friends. Testamentary gifting. This is again gifting at time of death and by way of a last will and testament. So here you have your limited liability company. You can make lifetime gifts, and then whatever you own at the time of your death goes down to your spouse if you're married. If you're not married, it goes to your children, or if you don't have other children, it goes down to your beneficiaries. I will tell you, if you have a business, you should not have a will. You should not be paying about transferring that property by way of a will, because you're going to have the commissioner of accounts potentially in between all business transactions when you die. And it can be a real goat rope to have to handle your business in a will when you're having to report all transactions to the commissioner of accounts. I bring this probate chart up to give you an idea that if you pass your business through a will and through probate, and if you don't have a will, that's going to be the default option to go through probate. This is the kind of morass you're getting into. If things can go lickety split, but you can get caught into one of these boxes and be stuck there for years. I settled a business that went through a will several years ago, and I think it took us 3 to 4 years, and the cost was in excess of $45,000 because we got caught in this probate process. So generally speaking, then we recommend that business interests such as an LLC interest be passed by way of a living trust. And here you see in this chart, you have the living limited liability company. It's being transferred to your living trust, and then it goes down to your spouse or your children or other beneficiaries through the trust at the time you die. All right, a couple of things about step up and basis. Again, Tom covered this, and I covered this a little bit earlier, but it's an important thing for you to know. When a capital asset, such as real estate, is gifted during your lifetime, it does not get a step up in basis for determining capital gains tax upon the subsequent sale of the asset. So if you bought something for $100,000 and now it's worth $400,000, if you were to sell that, you would have to pay $300,000 of appreciation in that asset. And if you gift that during your lifetime to your child's got the same problem. He's going to have to pay, he or she's going to have to pay capital gains tax on $300,000 because you have a cost basis of $100,000 and a sale basis of $400,000 with a $300,000 capital gains. And if you figure you're in the 20% bracket, that's a lot of money. That's $60,000 in capital gains tax. So you can see why this is such an important issue. Now, on the other hand, when a capital asset such as real estate is gifted upon the death, the asset gets a step up in basis. So let's take that same example. You have a piece of real estate that you purchased for $100,000. There's no adjustments to it. You sell it for $400,000. You pay $300,000. You're going to be taxed on $300,000 appreciation. If that same property is passed by way of a living trust at the time you die, you get a step up in basis. So now the property has a $400,000 step up in basis. If the recipients sell the property the next day, they don't pay any capital gains tax, whereas in the prior hypothetical, they had to pay $60,000 in capital gains tax. So you can see, again, you're not really happy about having to fork out that $60,000 in step up in basis problem because they gift it during a lifetime. Now, having said that, lifetime gifting is absolutely important in certain situations. One of which is if you've got potential creditors, and we're trying to avoid that because potential creditors might take the entire property, whereas if we keep it and do a lifetime gift, we only have to pay 20%. I say only because only is better than having to lose the entire asset. So capital gains tax upon the sale, we're assuming long-term capital assets, that is assets held for more than a year. Single filer, I hope I've got this right. Tom will correct me if I'm wrong here. 15% of the capital gains tax if your income is between $80,400 and $41,450. For joint people, it's 15% of the capital gains tax if your income is between $80,000 and $496,000. So again, if you've got a $300,000 appreciated property that you just sold, you're going to be paying, according to this chart, 15% of tax on that $300,000, which is, $45,000. So here's an example of a step up in basis. Parents give a lifetime gift to their daughter. The gift is real estate worth $100,000. Now it's worth $300,000. So you have a $200,000 appreciation. When the daughter sells the property, she may have to pay up to $30,000 in capital gains tax. Again, we're belaboring this point. If you come to someone like me, and may I say, we're going to talk, we're going to examine this problem with you, and we're going to weigh whether or not it makes sense to be gifting the business now or gifting the business later. And we pride ourselves in giving you good recommendations as to the approach you should take as far as gifting during your lifetime or gifting at the time of your death. Couple of things about income tax as they relate to gift taxes. There's no income tax to the donee on the receipt of the gift. So if you give a $100,000 gift to a child, they do not pay any income tax on that $100,000. Now, if it comes in a asset that's liquidated and results in a tax, that's different. But they're not paying tax on that income, and you're not able to take a deduction, assuming the donee's not a charity. So when you gift something, that's not a tax deduction to you, and it's also not income to the donee. Now, these rules change if we've got a charity that's a donee. Tom mentioned this as a $15,000 federal annual exclusion, which means this: if you want to give each of your kids a $15,000 gift under the Christmas tree, you can do that. You don't have to report that. You're A-OK. If your spouse, the other parent, wants to throw in another $15,000 besides adopting me, that's fine. If you adopt me, I'd be happy to take the $30,000. And so you're all under the radar. You don't have to. The IRS is not interested. Once you get over $15,000, so if you give a $16,000 Christmas gift, you are supposed to file a federal gift tax return, Form 709, to be filed in April of the year following the gift. So if you give something today to a child, and you gave them $20,000, then by next April you need to file a Form 709. Now, as Tom mentioned, because we have an $11.4 million exemption, you're not going to owe any taxes. It's just that the IRS wants to keep track of these gifts as it goes through the system. Exemption amount, $11.58 million, just mentioned that. That was what you can gift now at the time of your death. 23.16 million. Now, a lot of people do not rest on your laurels. This exemption falls back to 5 million or 5 plus, because it's going to be indexed to inflation in 2025. If there's going to be an administration change in a week or so, we could have the new administration lowering it even further. One of the candidates, for example, has suggested that he would lower the exemption amount to 3.5 million, I think is what it's going to be. So, don't be, make sure you keep on top of the federal exemption amount. This is simply the amount you can gift without having to pay any taxes. And basically it's a moving target. And again, no state-to-state taxes, at least in Virginia. That's not the case in either the District of Columbia or Maryland. So our neighboring jurisdictions do have a state-to-state tax. In fact, here it is in Maryland. You have a $5 million tax exemption. Plus, you have on top of it, Maryland's one of the few states that has both a state and an inheritance tax, 10% inheritance tax on collateral heirs. District of Columbia has a $5.1 million tax exemption. So if you've got property in either of those states, you need to be, you need to keep this in mind. So one of the reasons we do these webinars is to get business. We hope that you will become our client, and this is how you contact my office. You can request a copy of today's PowerPoint charts, recording of today's presentation, introductory book and evaluation and sign-up form, and 5% discount certificate. And I think the way we're